Interest rates, tariffs, inflation, potential Fed interest rate hike, Nvidia and the Mag 7 stocks. What is going on right now? So I'm going to play a video of Tom Lee right now. He's going to go through everything that he thinks. Then I'm going to give you my no BS breakdown on everything that Tom says and what I'm going to do with my portfolio to capitalize on this stuff. So here we go.
The markets according to Tom Lee, that is, Fundstrat's managing partner, head of research. He is with me here at Post 9. Welcome back.
Good to see you, Scott.
I said, so as you miss, inflation expectations spiked. You've got more tariff talk from the White House. And then I saw a report, too, from Jake Sherman, Punchbowl News. $4.7 trillion tax plan is what the Republicans are said to be discussing. I thought the market took a little bit of a move lower on that as well, just given where rates are, concerns about the deficit, et cetera. Your thoughts on all three?
Well, you know, it does seem like a pattern in 2025 as markets sort of take a hit on Fridays and maybe panic Monday. So I don't know if that's going to be the case. To me, I think the inflation headlines from UMich they're not great to see, but also I think that they are messed, or there's a political component to this, because if you break that down between Democrats who see 5% inflation and Republicans at zero, the blend is actually pushing this number up. But to me, it just gets messy around election.
So the University of Michigan, the survey that they do basically says what inflation expectations are supposed to be 1 year from right now. So the survey came out at 4.3% for the inflation rate 1 year from right now. Expectations were at 3.3%. So basically what's happening is higher inflation expectations are now going to be built into the stock market. And I get it, this is only one survey. And as Tom was just talking about, there's political things that go into this. So I'm sure the Democrats want to make it look like inflation is going to be higher because it makes it look like the Republicans are doing bad. And then the Republicans are going to say, oh, we think inflation is going to be lower, so it makes them look good. It's all this political game right there. But honestly, what I think is going on here is I think that the 4.3% that is expected 1 year from right now instead of 3.3%, I just think the 4.3 is too high. I think that as these inflation reports start to come through, I think they're going to slowly but bumpy go down. And once they start to go down, inflation expectations will go down. As those expectations go down, that's going to give the Fed more of a green light to cut interest rates even more. And as rates go down, usually the stock market does good because there's less competition between a bond yield and the stock market.
Let's be honest. There are broad concerns about parts of this agenda from this White House, including, I might add, from the Fed, that it could be inflationary when rates are already more elevated than I think the Fed would like to see. They'd like to be able to cut more, but their hands are tied. And one of the reasons their hands are tied because of tariffs and unknowns about inflation. Fair?
That's fair. I'm not sure the UMich survey reflects their assessment necessarily of the tariffs as much as, let's say, the bond market. And the bond market seems less concerned about it because, as you know, yields have backed off from 4.8 towards 4.5.
So you can see right here, Tom is talking about the 10-year bond going from 4.8%. So you can see right here, the open on 1/13 of 2025 was 4.8%. Now we're down to actually below 4.5 at 4.49%. This is good for the stock market. We need to see rates go down. And this is that on a chart right here. We had this big pump in rates right here. This is a 3-month chart. If I flip it to a 6-month, we've had this big pump all the way from like 3.6% all the way up to 4.8, like I just said. But I feel like this right here is a little bit overblown, this pump right here in the 10-year bond yield. I think that it's slowly going to normalize and slowly trend down as time goes on, and that is going to be good for the stock market.
But you're right. Tariffs are a reason to be uncertain, but so far I think if I looked at how markets reacted, I think they've actually taken them in stride.
I mean, your biggest takeaway thus far, you say, is that the market's proving resilient, which, I mean, let's be honest, too. Since the start of this bull market, it's been one heck of a resilient market. It's been able to deal with almost anything thrown in its face. You've had a couple of panic moments. Monday off of the tariff news, last August with the unwind of the carry trade, and then we just continue to set new highs.
That's right. And I think in 2025, a lot of investors thought maybe the playbook would change because we just put 20% years behind us. But I think with January being up 2.7%, and I think these sell-offs being bought, it does feel like the same market that we had last year.
What are you worried about?
Well, I'm worried about sentiment becoming too bullish, but actually
bullish?
But it's turned the other way. You know, sentiment actually has weakened pretty meaningfully. And I'd worry about a policy error from the Fed. And as you know, the bond market still thinks there's more than a 20% chance the Fed hikes this year. I think it would be obviously a policy error if they raise rates.
So we're going to look at this chart so I could show you why, if the sentiment gets too bullish, why it could actually be bad for the stock market. So if you look at this dotted line right here, this is the mean line. So the mean line is corresponding to the mean earnings growth of a company or the companies within the S&P 500, for example. So basically, when there's too much euphoria and too much optimism and too much bullishness in the stock market, the market will go into this phase right here where it starts to go into a bubble. So we'll see it start to take off right here. We'll start to get a little bit disconnected from the fundamentals. And then you see the first sell-off right here, and it's kind of like a bear trap where people that start to sell, they like, oh, the market's going to keep going down. But then it just blows up to here. So the next phase, you'll see the media attention, you'll see your friends talking about it, then there'll be more enthusiasm. Then maybe you decide to YOLO in when it's super high and you go into the greed phase right here. Then there's delusion phase where it just gets totally disconnected from the fundamentals, like way far away from the growth line right here. And then you're going to say, oh, it's a new paradigm, things are just going to keep going up forever, and then bang, blow off top, everything crashes. But if we do this on like a 10 to 20 year chart right here, you'll see a lot more correlation between what the stocks do and what the growth line of the actual companies do. So right here, it gets out of control, it goes way up and then way down. But in the long run, when you zoom out, this will just look like a little bump on the chart, and it'll basically be just hovering above and below the mean line of growth right here. So we don't want to see that. We want to see things kind of be in check, just going above and below this line right here, but not crazy bubbles and crazy crashes. And then the Federal Reserve policy error that Tom is talking about, he's basically saying inflation is trending down. He's been saying this for a while. I do agree with that too. And if we keep rates higher for longer as inflation starts to trend down, we are going to start to see cracks in the economy. So Tom is basically saying, yes, the stock market could go down if we go into a recession if the Fed keeps rates too high for too long. So we'll see what happens. We know what happened with the pandemic when inflation was coming pretty quick, and they were slow to react and slow to raise rates to try to bring inflation down. And now if the economy starts to weaken, the fear is that the Fed is going to be too far behind the eight ball to try to save the economy. So we'll see what happens with that. I do think the economy overall is pretty strong right now. I think that the Fed is honestly doing a decent job. Rates are a little bit higher than where I would like to see them, but I want to see more inflation progress going forward actually realized in the CPI numbers. So time will tell.
What about a policy error from the White House?
That's also something markets worry about, yes. But so far, I would say that the news that we've seen on tariffs, they've had more bark than bite, meaning they've proven to be opportunities for investors to buy.
What would you buy?
Well, the big news this week in our minds is the ISM moved back above 50. That really does point to earnings dispersion improving. So I like industrials, the financials. I mean, the small caps, which have been, not a great outperformer yet, but we still think small caps are going to do well this year.
And what happens if some of the uncertainty around D.C. and policy has a more negative impact on not only sentiment, but actual transactions? I saw a stat today that M&A is off to an incredibly slow start this year, when part of the narrative coming into this year was animal spirits. Can't tell you how many times I heard that phrase over the last 3, 4, 5 months. And What if we don't get that?
It's still too early, right, because we're only 1 month into the year. The recovery in optimism, both in the NFIB and even the ISMs, I do think it would sort of argue CEO confidence should be better. So I would expect M&A.
We had all but one of the mega caps report. We got to wait a couple more weeks for NVIDIA. What's your takeaway?
Well, it's been a good earnings season so far. The Mag 7 as a group hasn't been great. In fact, they've been a drag on the S&P this year. So part of it is it's telling me I think a lot of good news is baked into some of these names, and especially with CapEx going up. But it doesn't mean I don't think they're market performers. I just think the outperformance this year comes from financials, small caps, industrials.
Canaccord Genuity today on the Mag 7. We think it's fair to say this has been the softest quarter for this group collectively in the last few years. Is that a meaningful softness, that maybe the best times for a while are behind it?
Well, and that's a relative term, right? Because on an absolute basis, these companies are growing far faster than the S&P. But from a what's priced into the stocks, clearly it wasn't a market surprise. That's why year to date they haven't been great.
What about you're paying up, in some respects for declining revenue growth, especially in key areas like cloud for some of these players where that's an essential part of why you were willing to pay up in the first place? That matter?
Well, these are secular stories. So to me, stocks might actually underreact to earnings and they might overreact to earnings over time, and they may consolidate for several years. But to me, the key drivers for why you want to own the Mag 7 haven't changed.
Seems like these names have sort of separated themselves from each other. If you look at a chart, for example, of Meta, it's been magnificent. It's like the magnificent one.
So the Mag 7 stocks did have a slow start to the year this year, but that's totally fine. I mean, they've been absolutely pumping the last few years. They've been blowing everything out of the water. And right now, I feel like valuations did get a little bit stretched on the Mag 7 stocks. So right now what's happening is the stocks are kind of just growing into their valuations. So as they report quarter over quarter over quarter, the earnings are going up, but the share prices are staying relatively flat. So they're just growing into that valuation, and that's going to bring the PE ratios down, which is what I personally want to see. They had a 25% year plus last year, 25% plus year the year before that. It's totally fine if we don't see a 25% year this year. I wouldn't be surprised if we end up pretty much flat for this year. I think there's definitely going to be a lot of volatility this year in the stock market. And of course, nobody knows exactly where the top or the bottom is. The key is to just invest when something is either grossly overvalued or grossly undervalued. Obviously, if things are grossly overvalued, maybe you want to go buy puts on it or something like that. And when things are cheap, you can maybe go sell puts or buy calls. That's what I'm doing all day long, and I've made millions of dollars doing it. I average roughly $30,000 a month right now doing stock options. So if you guys want to learn how I do that stuff, click the link below to get my course. It's 60% off right now. If you don't want to do that, watch this video right here. It's me going through one example of how I do stock options, one of my favorite ways. I'll see you there.